Welcome back to The Money Puzzle. I am Eric Douglas. This is Aaron McAndrew. This is a production of Family Wealth Planning Partners. We are so glad to have you. Today, we spend a lot of time talking about our risk-off retirement strategy, and I think we wanted to do a little bit of a deeper dive today on exactly what that is, what we mean by that. I know we typically beat around the bush, or we do talk about it in most of our episodes to some degree, but I think we just wanted to do a little bit of a deeper dive today to explain in a little bit more detail what exactly we mean by that and how we implement it into our clients' portfolios and ultimately what type of success rate that we have. I'll start with you, Aaron. What is risk on, risk off? What do we mean by that?
So I'm going to give you a little bit of how it became, how we kind of thought, how we kind of rebalanced and changed the way we're doing some things in client portfolios when the markets were going down. What happened with the bond market, not necessarily the stock market last year. The stock market, everybody's like, oh, the stock market's bad. The stock market was really bad last year. Well, historically, the stock market does that.
It did what it was supposed to do. It was volatile, and that's a feature, not a bug of the stock market.
Right.
By the way.
We had literally 10 plus years of solid growth in the stock market. It went down during COVID, right? And then because of the interest rates cut down to zero, and because of the easing that was the amount of stimulus and everything that was put into the back into the economy, it propped it right back up, probably a little on a false note. And what we're seeing is we're paying the price for that last year and even into the beginning of this year. And then the markets this year have rebounded a lot. But the bond market is really the one that we want to talk about. Bonds traditionally have been the fixed income or the safe portion of someone's portfolio. A 60-40, which is an average retirement portfolio.
The bedrock of our industry, right?
Right.
Yeah.
And it's basically what that is 60% invested in stocks, which is your growth portion of your portfolio or your value that's paying some sort of a dividend or whatnot. But it's 60% invested in stocks, 40% invested in bond funds. The bond funds were there to pay the income of the portfolio, and that was supposed to be your safe asset. Well, that worked for 40 years almost, right? Well, for a while it's worked. We hadn't seen what happened last year with the bond market since the 1980s. 1980s is the last time that happened. We were in a rising interest rate environment then. We are still in a rising interest rate environment now. We were significantly at record interest rate hikes last year, which caused the bond market to plummet. If you're in a portfolio and you are in a retirement portfolio and you are actually retired and you're drawing income from that portfolio and that bond portion is supposed to be your safety net there, you're seeing people in 60-40 portfolios down last year 15 to 17%.
Just as much as the S&P.
Just as much as the S&P. So bonds are not, I'll reiterate, bonds are not supposed to go down like that. They did because of the environment we were in, unprecedented, that we raised the interest rate, I think it was 6 or 7 times last year.
And they're not done yet.
And they're not done. When interest rates rise, bond values actually fall. So that's what happened with the bond market last year. It wasn't the stock market. Yeah, the stock market caused portfolios to go down, but again, the stock market does that. The bond market's what took everybody by shock. Anybody that was in target retirement date funds, anybody that was in a 60-40 portfolio or had any exposure to bond funds, bonds did not do what they're designed to do last year because of the environment that we were in. So that brings us to what we were doing for people that are nearing retirement or people that are in retirement is we developed this risk off, risk on strategy. Risk off essentially is instead of using bond funds, we are bucketing out our risk off strategy, and then we create a growth bucket for our risk on strategy. Risk off is going to be your first 2 to 3 years. The first bucket is going to be your first 2 to 3 years in retirement that you're going to be risk off. And by risk off, what we mean is no market risk. You're not going to be tied to the ups and downs of the stock market.
There's no volatility there.
No volatility there. So for example, if what happens last year with the stock market or the bond market for that matter, going down double digits, 20%, 30%, 15% for bonds, whatever that is, that bucket is not going to go down like that. It's not going to have that volatility. It's not going to have that market risk in there. It's going to be liquid. It's going to be based off of what your needs are in the first 2 to 3 years. We'll talk about how we back into those needs here in a minute. But that's the first bucket. It's going to be more like cash equivalencies, where we're trying to get interest, we're trying to get yield, which right now we can get yield because of where the interest rates are on that for the first 2 to 3 years, but it's completely out of the market. It's not tied to the stock market at all. It still has other risks, but those risks are small for what we're trying to get out of this compared to market volatility. The next bucket that we would look at is going to be taking you from the next 5 years or the next 7 years up to your first 10 years of your income in retirement. That is going to be used for, again, no market risk. We're going to use investments in that bucket that's not going to be tied to the market. They're going to be where you can't go down if the stock market goes down or whatnot. You have a floor there, and it's paying you either a guaranteed interest rate that it's paying you each year, or it's tied to a stock market index and can get market-like gains, but without the losses. Okay, so that's going to be there. It's going to be usually set up on like a term, meaning a 5-year, could be a 7-year, whatever we need it, whenever we need to use that income. So once it becomes available, now that goes down and feeds that first bucket again. That turns into the cash you're going to use in 5 years or in 7 years or whatnot.
I think ultimately, yeah, for bucket 2 especially, we're trying to get some growth.
Yeah.
We need some growth because we need to get some, we can't have everything tied to cash or cash equivalents or very, very, very liquid assets, because we need to keep up with, we have to avoid inflationary risk, right? So we need to beat inflation. We need to get some level of return, but we don't want to get the same type of volatility or the same type of return that you're going to expect within the stock market. Because if you're looking for stock market returns, you have to accept stock market risk. You have to accept stock market volatility, and we want to eliminate that. Ultimately, what we're trying to do is create 10 to 15 years worth of income, retirement income, that is not tied to the stock market in any way, shape, or form. We want to eliminate stock market risk so you can live the next 10 to 15 years of your retirement. And that number is going to depend upon your personal situation. But ultimately, we want to provide the next 10 to 15 years worth of retirement income for you, stock market risk free. We don't want it tied to any type of stock market risk, because we want you to go to bed every single night knowing that when we have years like 2020, when we had COVID, right, or 2022, when it was an all systems failure and everything went down, you're not exposed to that. And you can go to bed every night knowing that I don't care what the stock market does, because I know that I've got income coming in for the next 10 years, regardless of what the stock market does.
And then the final bucket that we use is your growth. That's your risk on bucket. That's your risk on bucket. So that is going to be invested in the stock market. Okay, so that's going to be invested. But like we've said before, if you go back any 10-year time period in the history of the market, it's positive. Okay, it's not negative. So as you use money, as you go through retirement, the growth on that bucket is turning around and feeding the other ones. So these investments, this strategy is basically an ongoing income strategy to carve off gains that you have here, to carve off the growth, and feed your income as you age and as you go through retirement. So that you have risk on and you have risk off.
I had a client recently that wanted to redo his kitchen. Great goal. He had just retired, and he came in, he called me, wanted to schedule a meeting because he had this goal that he wanted to accomplish. So yeah, come on in, we'll talk about it. We'll run through some numbers and run some scenarios. And basically, ultimately, what he was trying to determine was whether or not he could afford to take money from his accounts and cover the cost of doing a kitchen renovation, because his wife really, really wanted it. They've been holding off on doing it. But he was very, very aware at the time of what the market was doing. And so he was like, well, can I sell? Can I afford to sell? And do all? Like, yeah, absolutely, come in, we'll talk through it. Ultimately, what we were able to do, what we were able to illustrate was, yes, absolutely, you are able to pay for this kitchen renovation, and let me show you how. Because we had bucketed out these different strategies within his portfolio, we had bucketed out 10 years worth of income that was not tied to market risk. What he was concerned about was selling out of the market at a loss, and further basically cementing, if you will, his losses in his accounts. Well, I showed him, and I showed him very specifically, well, this is the bucket of money right here that we're going to take this, the money that you need to do the kitchen renovation, we're going to take it from this account over here. It's not down like this side of the account. It's not down like this side of the portfolio is, because that's the long-term portion of your portfolio. Over here is where we're going to take the money from. We're not selling at a loss over here. It's like, oh yeah, wow, that's right. You know, we had talked about this before, but he's very visual. He needed to see it. He needed to come back in the office, and I illustrated it for him, and I said, yep, we're taking it from right here. This is how we're going to do it. This is how it's going to affect your overall plan. It didn't. He was fine. He was just overthinking it a little bit, which is totally fine, right? And so we illustrated it for him. Long story short, he took the money out, was comfortable. He's going to enjoy that kitchen. His wife is going to enjoy that kitchen far more than he's going to enjoy that money sitting in his retirement account that he's probably never going to use. Every day they get to wake up
Yep.
and they get to enjoy a cup of coffee in their brand new kitchen. Even to the tune that it's funny because a couple of months later he asked me, yeah, we did the kitchen and now the wife's talking about the deck. So we had basically the exact same conversation. Okay, how much money do you need? What do you, but we walked him through it. Now he's got a brand new deck and he's got a brand new kitchen, and you know, life is wonderful and he's happy and his wife is even happier, right? So, but that's why you retire. You retire to go to enjoy your life, to go to enjoy
Your lifestyle.
You're preserving your lifestyle, and you don't want to wake up every day, especially if you're spending more time at home, in a kitchen that you hate. What's the old saying, right? Happy wife, happy life. Well, there you go. The wife's a lot happier. He's a lot happier because his wife's happier, and he's enjoying retirement that much more because we were able to ensure a risk-off retirement strategy for his portfolio where he could feel comfortable taking a certain amount of money from his accounts without worrying if it was going to completely throw off his retirement. And it did not. And he's still good. All of his probabilities of success are still very, very high. He's in a really good spot.
And the thing about this risk on, risk off strategy is it's not cookie cutter. What I mean by cookie cutter is not just one size fits all. Here, everybody's going to have the first bucket, everybody has 3 years of X number of dollars. Everybody has the second bucket, everybody's got 7 years of X number of dollars. And then the last is X percent of whatever, whatever it is. It's not cookie cutter. So it's all dependent on what your lifestyle is. So when we back into the planning, when we do the income planning, we figure out what that number is that you're going to need to use each month. We consider your permanent and predictable income sources, your Social Security. What's that strategy? At what age are you going to be turning that on? What's the dollar amount you're going to be receiving? Any pension income that you had? Do you have any annuities that you're taking income off of right now? We factor in all of that permanent and predictable income sources, and then we do a gap analysis on you. Okay, so here are we at. We're looking to see, okay, we need X number of dollars in retirement, and we've got this much money in permanent predictable income, which is what we like to call mailbox money or whatever, guaranteed income that's coming in to your paycheck, going into your account every single month, not tied to the stock market. We figure out what that gap is there, and then we start feeding those buckets that way.
Well, let's use a fun analogy here. We're from Kentucky. What is our beverage of choice in the state of Kentucky?
Bourbon.
Bourbon, right? Can you tell me what requirements are there in order for a drink to be considered bourbon?
It's got to be over 50. It's got to be over 50%.
50% corn.
Corn. Yep.
And it's got to be aged in oak barrels that have never been used.
Yep.
It doesn't necessarily have to come from Kentucky,
No.
although that's a common misconception, right?
Right.
But there are some very specific requirements in order for it to be considered bourbon. Now, are all bourbons the same?
No.
So
Not anywhere close.
This is how our risk-off retirement strategy is like Kentucky bourbon.
Yeah.
Okay? The guidelines, the parameters are essentially the same. The idea is the same. The idea is we want to segment certain portions of your overall portfolio, and we want to broadly diversify the amount or the types of risk in your portfolio, okay? That's the same for every single client that walks in the door. The way we do that, though, is not going to be the same for every client, just like every bourbon. Yes, every bourbon is going to have at least 50% corn, and it's going to be in aged white oak barrels that have never been used before. And they can only be used once. Once they're used, you got to ship them over to Scotland. They can be used for Scotch,
Right.
but you can't use them for bourbon. Anything that comes out of that barrel in the future is not going to be bourbon by law. So there are very specific parameters in order for something to be considered bourbon, but by no means is all bourbon the same. Pappy Van Winkle is not Kentucky Tavern, right?
Right.
So now ultimately we want to make every retirement portfolio look like Pappy Van Winkle if we possibly can, maybe a little Blanton's or something like that. But at the end of the day, yes, the parameters are the same. We have certain things that we want to accomplish and certain ways of accomplishing it, but it's strategy versus tactics, right? The broad concept is the same, but the way that we do it for each individual client is going to be tailored very specifically to them based upon, let's say, based upon their taste profile, if you will.
Right. So that's a little bit about risk on, risk off. That's how we talk about it on a lot of these episodes, on all these different podcasts. But like Eric said, nothing's the same in terms of, it's not cookie cutter. It's all tailored, and and even the investments that we use. The markets change every year. What we're getting right now in a money market fund may not be the same that we're going to get next year on a money market fund. So we're going to have to find what the best investment it is to use in place of that money market fund. So it's not, everything we're doing is tailored, not just on that level, but also on the investment management.
I'll even add one more thing too. I mean, when we craft a retirement income plan, you have to stop being so solely focused on return. Ultimately, when we're creating that risk-off portfolio, we're not shooting for the moon here. You're not going to get 20% returns in those buckets. It's not designed to do that either, by the way. We're far more concerned with downside protection at that point, because that's a far greater risk to your overall success in retirement, or the overall success of your retirement plan is eliminating downside risk in the early years. So if we're eliminating all downside risk throughout the first 10 to 15 years of your retirement income plan, your retirement is going to be far, far more successful than if we just threw everything in the stock market and say, wait, because over time the stock market's going to do well. Absolutely. But if we get a few bad years at the beginning, then you could be in trouble, and we need to avoid that.
Which, by the way, the first 10 to 15 years of somebody's retirement is usually their most active. Well, it isn't just usually, it is their most active years. So most enjoyable, most active years.
Yeah. So if anything we said today hits home with you, if you would like to schedule your own risk-off retirement strategy session, please click the link in the podcast notes or go to our YouTube channel and click the link from there. You can schedule a meeting with myself, with Aaron, with our team. We would love to sit down with you and walk through what your personalized risk-off retirement strategy is going to look like. Once again, Eric Douglas, Aaron McAndrew for The Money Puzzle. Thanks for being with us, and see you soon.